Welcome to the Deep Dive. We are thrilled to have you here for a very special Talk Tickers edition today.
Yeah, we have a really fascinating one lined up for you.
We absolutely do. So our mission today is pretty straightforward. We are breaking down the Q2 2026 earnings call for Crown Castle Incorporated.
Right, ticker symbol is CCI.
Exactly, CCI. We've got the full transcript of the call right here, featuring the CEO and the CFO.
And for those of you listening who are retail investors, our goal is to really extract the most critical insights for you.
Yeah, we want to be super data forward with this. We're going to translate all that Wall Street jargon into plain English.
Tell the real story behind the numbers.
Right. And ultimately give you an actionable bottom line on whether you should hold, fold, or buy this stock.
It's going to be a fun one.
It is. So here is the hook. Crown Castle just hit this massive milestone on May 1st.
Oh yeah, a total structural shift.
They sold off their small cell and fiber businesses. And by doing that, they became the only publicly traded pure play U.S. macro tower operator.
The only one.
Okay, let's unpack this. Because they just sold off a huge chunk of their business to become this pure play operator.
Right.
So my question to you is this some genius streamlining move to just dominate one sector? Or, is this a strategic retreat?
Well, to really answer that, we first have to look at the immediate financial reality they are operating in right now.
Okay, lay it out for us. Let's get into section 1, the headline numbers.
So on the call, management painted a pretty optimistic picture of their baseline. They reported Q2 organic growth of 3.9%.
Which comes out to about $38 million, right?
Yeah, exactly. 38 million, but, and this is a massive but, that 3.9% completely excludes the impact of Sprint cancellations and the DISH network terminations.
Wait, really? They just carved those out of the headline number?
They did, and it gets a little murkier. That 3.9% actually includes a $5 million increase in what they call other billings.
Other billings, okay.
Yeah, it's an anomaly. If you exclude that $5 million bump, their true organic growth for core tower leases is actually 3.6%.
Wow. Okay, so they are boasting about 3.9% organic growth, but only after stripping out all the bad news from Daesh and Sprint.
Pretty much, yeah.
Isn't it like saying, other than hitting the iceberg, the Titanic had a great voyage?
That's a great way to put it. You really can't ignore the noise here.
Because that noise is costing them real money. Let's look at the headwinds.
Right, the headwinds are brutal. They took a $5 million hit just from lingering Sprint cancellations.
And Sprint merged with T-Mobile years ago.
I know, it takes a long time for those network consolidations to fully hit the books.
The DSH number is the one that really jumps off the page at me.
Oh, absolutely. A $49 million drop in a single quarter due to DISH terminations.
$49 million just evaporating.
Yeah. Now, CFO Sunit Patel did try to spin this a bit. He said if you exclude DSH from the prior year's billings entirely...
Like pretend DSH never existed.
Exactly, just erase them from the historical comparison. If you do that, he says organic growth actually hits 4.2%.
I mean, sure, the underlying engine might be fine, but you can't just pretend your bigger customer didn't just stop paying you.
You can't. And that DISH situation is going to be a major part of the story later on.
Definitely. But before we get there, we need to talk about another confusing number they threw out. A $25 million drop in non-cash straight-line revenues.
Ah, yes. Straight-line revenue. This always trips people up.
It totally does. If I'm a retail investor and I see a $25 million drop in revenue, I'm panicking.
Right, but you really shouldn't because of how REIT accounting works.
A real estate investment trust, which Crown Castle is.
Exactly. So let's translate this jargon. When a carrier like Verizon signs a 10-year lease on a tower, that lease has rent escalators.
Like a 3% bump every year for inflation.
Right. So year 1 is cheap, year 10 is expensive, but GAAP accounting.
Generally accepted accounting principles.
Yeah. GAAP rules say you can't report the revenue as it scales up. You have to take the total value of the 10-year lease, average it out, and report a flat, straight line of revenue every single quarter.
Oh, so in the early years of the lease, you're reporting way more revenue on paper than the cash you're actually collecting.
Exactly. And in the later years, you're reporting less revenue on paper than the actual cash coming in the door.
So a $25 million drop in straight-line revenue just means their overall lease portfolio is getting older.
Precisely. It is a paper loss. It does not mean they collected $25 million less in actual cash.
Okay, so if straight-line revenue is basically a paper distortion, and net income is ruined by depreciation on the steel towers, what metric should you actually care about?
The Golding metric for a tower company is AFO, adjusted funds from operations.
AFO.
Yeah. It strips out the straight line rent weirdness, it strips out depreciation, and it subtracts routine maintenance costs.
So it's basically the cold, hard, distributable cash they made that quarter.
It is the absolute ground truth of their cash generating power.
Okay, that makes sense. Now let's talk about the absolute most important cash event of the quarter. The $8.4 billion windfall from selling the fiber business on May 1st.
This is huge because capital allocation tells you everything about a management team's discipline.
Right. Where did the money go?
What's fascinating here is how violently Crown Castle is pivoting. They didn't hoard the cash and they didn't go buy some other random company.
Thank goodness.
Yeah, they immediately went on a massive deleveraging campaign. They took $7.2 billion of that $8.4 billion and just wiped out debt.
Wow. $7.2 billion just erased.
And it's the kind of debt they targeted that's so smart. They paid off $5 billion in floating rate debt.
Which is brilliant, right? Because floating rate debt in this high interest rate environment is just a ticking time bomb.
Absolutely. Every time rates stay high, their interest expense was hurting their AFO.
Yeah.
So they just killed the flowing debt entirely.
That's such a defensive, smart move. What else did they pay down?
They executed $500 million in open market repurchases of their own bonds.
Wait, explain that. They bought their own debt back.
Yeah, because older bonds with low interest rates are currently trading at a discount. So they likely bought back their own debt for, say, 90 cents on the dollar.
That's just great financial engineering. Retiring principal at a discount.
Totally. And then they paid off $1.75 billion in unsecured notes that were maturing in June and July.
So they completely cleared the runway. No immediate debt panics.
None. And then they did something that proves they are a pure play tower company now. They voluntarily shrank their revolving credit facility.
The corporate credit card.
Right. It was at $7.2 billion. They dropped it down to $4.5 billion.
Why would a company voluntarily lower its own credit limit by nearly $3 billion?
Because trenching fiber optic cables underground costs a fortune. It requires a massive credit line.
But just owning a steel tower doesn't.
Exactly. Towers require very little maintenance capital. They don't need a $7 billion credit card anymore.
So they save on the bank fees for maintaining that massive line of credit.
Right. And they ended the quarter at a leverage ratio of 6.3 times net debt to EBITDA.
Which is right in their target zone, isn't it?
Yeah, their investment grade target is 6 to 6.5 times. So they are perfectly positioned.
Okay, so that accounts for $7.2 billion. They still had over $1 billion left from the fiber sale.
Yep. And they used $1 billion of it to execute a share repurchase program.
They bought back stock.
They retired over 11 million shares at an average price of $88.66.
Now, a lot of people think stock buybacks are just a gimmick to boost the stock price.
Usually they can be, but for a REIT, it's entirely different.
Because of the dividend, right?
Exactly. REITs have to pay out massive dividends. By retiring 11 million shares, they permanently remove those shares from the dividend pool.
Meaning they don't have to pay a dividend on those shares ever again.
Management said this move alone saves them $47 million in annual dividend obligations.
$47 million a year. Just free cash flow, freed up in perpetuity.
Right, so balance sheet, completely cleaned up.
Which they are really going to need, because it's time to move into section 2, the story behind the numbers. And we have to talk about the Dish drama.
We do. It's a massive dark cloud hanging over the whole company.
Dish Wireless is in bankruptcy. We know this. They were trying to build this fourth nationwide 5G network from scratch.
And they leased a ton of tower space from Crown Castle to do it.
Long-term, multi-billion-dollar master lease agreements. And now Dish is in Chapter 11.
Which means Dish can legally reject those contracts and walk away.
So Crown Castle is aggressively pursuing $3.5 billion in contractual claims against Dish. $3.5 billion.
It's an existential threat to their near-term growth, but Crown Castle has a very unique structural advantage here.
Yeah, they mentioned a bankruptcy remote escrow account on the call.
Yes. There is a $2.4 billion escrow account, and it is bankruptcy remote, meaning it's a legal fortress.
So Dish can't use that money to pay off some random office supply vendor or something.
No, the bankruptcy judge can't touch it for general creditors. It was specifically earmarked for infrastructure claims before the bankruptcy even happened.
Okay, but when does Crown Castle actually get access to that fortress?
The trigger is the AT&T and EchoStar Spectrum deal closing.
Which the CEO said they expect to happen this month, right?
Right. Once that closes, the $2.4 billion gets funded. But Crown Castle has to share it.
Who else is claiming it?
American Tower is the other major claimant. So even if they split it 50-50, Crown Castle might get $1.2 billion.
Which is great, but it's still way short of their $3.5 billion claim.
Exactly. Which is why there is a brutal legal knife fight happening in the actual Chapter 11 proceedings.
Let's get into the weeds on this legal fight because it's fascinating. Crown Castle is on the Unsecured Creditor Committee.
Right. But DSH is trying to use a specific bankruptcy rule to cap the damages they owe.
Section 502B6, I think it was.
Yeah. DSH is trying to impose a 15% cap on Crown Castle's claims.
Which, if you think about it, sounds insane. If I sign a 20-year lease and break it after 2 years, I owe you the remaining 18 years.
Normally, yes, but this 15% cap rule was written during the Great Depression.
Oh, really? Why?
To protect retail chains. Imagine a massive department store goes bankrupt. If they had to pay out the full 30-year value of every mall lease they broke,
the landlords would just eat the entire bankruptcy estate.
Exactly. The bondholders and employees would get zero. So Congress capped landlord claims at 15% of the remaining term.
Okay, so Dish is saying a cell tower lease is a real estate lease, so we only owe you 15%.
That's their argument. But Crown Castle executed a brilliant countermeasure.
What did they do?
They didn't passively wait for Dish to file Chapter 11. Because Dish stopped paying rent months ago, Crown Castle officially terminated the contracts for non-payment early.
Oh, they accelerated the penalty before the bankruptcy even started.
Yes. They're telling the judge, this isn't a future lease being rejected in bankruptcy. This is a past due, fully matured debt that defaulted before you filed.
Wow. So they arguing the 15% cap doesn't apply at all.
It's a very aggressive, razor-thin legal distinction. We'll have to see if the judge buys it.
But it shows they are playing offense.
Yeah.
And speaking of offense, here's where it gets really interesting. The edge computing pivot.
This is a huge shift in the narrative.
They are initiating trials to turn their tower sites into edge data centers.
Right, because the AI boom needs compute power, and traditional data centers have a massive bottleneck.
Yeah, the CEO said the traditional data center industry has a 15-year backlog.
A 15-year wait just due to power constraints and permitting.
So Crown Castle says, hey, we have over 40,000 tower sites. They already have secure fences, climate control shelters, fiber optic backhaul, and commercial power.
It's move-in ready real estate for servers.
It's like Airbnb for data processing. Instead of building a massive mega hotel data center that takes 10 years to permit, they're renting out spare rooms at the base of thousands of cell towers.
That's a perfect analogy. You put the compute right where the users are.
But, okay, I have a major question about this.
What's that?
The power limits. They mentioned on the call that they can provide up to 0.2 megawatts of power at these sites.
Right, about 200 kilowatts.
200 kilowatts. AI training clusters require tens of megawatts. Is 0.2 megawatts actually enough to move the needle, or is this just AI hype?
It's a great question, but you have to separate AI training from AI inferencing.
Okay, break that down for us.
Training a massive model like ChatGPT takes hundreds of megawatts in a giant hyperscale facility. A cell tower cannot do that.
Right.
But once the model is trained, it has to be deployed to actually answer your questions or analyze live video or do fraud detection.
The real-world application.
That's called inferencing. And inferencing doesn't need huge power grids. It needs low latency. It needs to be physically close to the user.
So the data doesn't have to travel from your phone all the way to Virginia and back.
Exactly. It gets processed right at the base of the tower.
200 kilowatts is enough for that.
Yes, a high-end AI inferencing server rack might only pull 30 or 40 kilowatts. So Crown Castle could easily put 4 or 5 racks in their existing shelters using the commercial power already there.
Wow. And they don't have to spend a fortune building new infrastructure.
No new capital required. It's high-margin, low-risk optionality for them.
That is fantastic. But as long as we're talking about technology threats, we have to address the elephant in the room that every retail investor worries about.
The satellites.
Direct-to-device satellite communications, Starlink, AST Space Mobile. If satellites can just beam 5G directly to my iPhone from space, why do we need physical steel towers?
Management took this head on during the call, and they brought the physics to back it up.
They really did. They totally dismantled the idea that satellites will kill cell towers. It
fundamentally comes down to the inverse square law of electromagnetic radiation.
Right. So a regular cell tower is what, a couple of miles away from you?
Yes. But a low Earth orbit satellite is 300 miles straight up.
And because of that distance, the signal strength arriving from space is roughly 10,000 times weaker.
10,000 times weaker. And remember, communication goes both ways. Your phone has to shout back up to the satellite.
Oh, man. If my phone has to transmit a signal 300 miles into space, my battery's going to die in like 10 minutes.
Exactly.
Yeah.
The transmit power required would just cook your battery.
Not to mention the logistics. The CEO pointed out that 90% of mobile data usage happens indoors or inside cars.
And satellite signals need a clear line of sight to the sky.
They can't punch through a concrete office ceiling or the roof of your car.
They absolutely cannot. Terrestrial towers can because they are close and powerful.
But the real kicker was the capacity argument. This blew my mind.
The spectrum reuse math, it's brutal for satellites.
A satellite beam covers this massive footprint, right? Like 100 to 600 square miles.
Right. And a cell tower only covers maybe 3 to 20 square miles.
Intuitively, you'd think the bigger satellite footprint is better.
But it's actually the worst thing for network capacity because spectrum is finite. Everyone inside that 600 square mile satellite footprint has to share the exact same bandwidth.
So if 1 million people in Chicago all try to stream a video on the satellite network at once, the whole thing crashes.
Instantly. But with terrestrial networks, because the towers only cover 3 miles, you can just reuse those same frequencies on the next tower down the road.
Spatial reuse.
Exactly. The CEO said terrestrial cell sites support 30 times more users per megahertz of spectrum than satellites.
30 times more. So satellites are great if you're lost in the woods or in rural Wyoming.
They are a great complement to the network, but they physically cannot replace towers in suburban or urban areas.
Okay, so the structural narrative is intact. Towers aren't going anywhere. Let's transition into section 3, management guidance. What do they say about the rest of the year?
The biggest takeaway here is that management officially declared 2026 as the low point for organic growth.
They called the bottom.
They did. They are saying the Sprint churn, the DISH implosion, the macro pullback, this is the trough. We are absorbing the worst of it right now.
But even sitting in the trough, they actually tweaked their guidance up a little bit.
Yeah, they increased their site rental revenues outlook by $5 million.
They maintained their adjusted EBITDA outlook.
And they increased their full-year AFFO outlook by $5 million, which was driven directly by the lower interest expense from paying off all that debt.
Now, maintaining that EBITDA outlook actually took some serious internal cost cutting, didn't it?
It did. Because they had a $15 million reduction in operational costs, but that was offset by a $20 million drop in their services contribution.
Okay, let's talk about the cost cutting first. $10 million saved in site rental costs.
Right. A lot of people don't know this, but tower companies usually don't own the dirt under the tower.
Right, they lease it from a farmer or a municipality.
And those ground leases have rent escalators. So Crown Castle is aggressively buying out those ground leases to own the land outright.
Closing an 11% gap with their peers like American Tower, that's great for margins.
And they also cut $5 million in SG&A by using AI orchestration software to speed up permitting and engineering.
But then there's the services softness, a $20 million drop.
Yeah.
Why?
Management cited leadership changes and massive layoffs at the major mobile network operators, the MNOs.
The big carriers, T-Mobile, AT&T, Verizon.
Right. They are laying off engineers, so decision-making on deploying new equipment has slowed to a crawl.
But wait, I have a question here. The CFO said that 90% of their 2026 organic growth is already contracted.
True.
If it's legally locked in, why is there a $20 million crater in services? Are the carriers just backing out of their contracts?
No, this is a vital distinction for retail investors. You have to separate leasing revenue from services revenue.
Okay, how are they different?
Leasing revenue is the rent. The carrier signs a 10-year contract to reserve physical space on the steel. That rent is legally locked in.
So the check clears every month, whether the carrier puts an antenna up there or not.
Exactly. But services revenue is discretionary. Crown Castle also has divisions that physically install the antennas and run the cables. So a carrier might keep paying the rent, but say, hey, we just laid off 500 engineers. We are going to freeze the actual installation project for 6 months.
Got it. So the contracted rent is perfectly safe, but the installation services revenue takes a temporary hit.
Exactly. It's a timing issue, not a fundamental cancellation.
Okay, that makes sense. So if we connect this to the bigger picture, what are the catalysts that will force the carriers to start spending on installations again?
Management laid out 3 major future catalysts. First is AT&T's deployment of 600 megahertz spectrum.
Once that spectrum deal closes, AT&T has to actually put radios on the towers to use it.
Right. Catalyst number 2 is the sheer volume of data demand. U.S. mobile data consumption is projected to double in 5 years.
From 25 gigabits per month per phone up to 52 gigabits.
And a huge driver of that is uplink traffic from AI and wearables.
Meaning data going from your phone up to the cloud instead of just downloading Netflix.
Yes. And because phones have weak transmitters, heavy uplink traffic forces carriers to put towers physically closer to the users.
Densification.
Exactly. And the third catalyst is the biggest, the FCC's 800 megahertz spectrum pipeline.
With auction starting in 2027.
Right. And this is mid-band and high-band spectrum. The physics of high-frequency spectrum means the signal doesn't travel as far.
So if a carrier buys that high-frequency spectrum, they can't just put one antenna on one big tower.
No, they have to deploy equipment on almost every single tower in a city just to get continuous coverage.
It forces densification.
The spectrum auctions are the starting gun. The tower business is a game of extreme patience.
You wait out the trough, and then you reap the rewards when the carriers actually deploy the hardware years later.
Exactly.
Okay, we are in the final stretch, section 4. The bottom line, let's synthesize all this for the retail investor listening right now. Give me the bear case first. Why should someone fold this stock?
The bear case is very real. The DTH bankruptcy is a massive $3.5 billion cloud hanging over them.
A total uncertainty.
Right. And carrier service spending is undeniably soft right now because of telecom layoffs and macro digestion. If you want explosive short-term growth, this is not the stock for you.
Very fair. Okay, what is the bull case?
The bull case is that Crown Castle is now a lean, mean, pure-play tower machine.
The fiber distraction is gone.
Gone. They cleared $7.2 billion in debt, they neutralized their floating rate risk, and 2026 is officially the trough.
Plus, they have the edge computing trials as free optionality.
Exactly.
So what does this all mean for the listener? Actionable takeaway time.
If you hold CCI, you're betting that the laws of physics regarding 6G spectrum and AI data demands will physically force carriers to densify.
It's an infrastructure play.
It requires a rigid 3 to 5 year time horizon. You sit in the trough, collect the dividend, and wait for the 2027 spectrum auctions to trigger the next massive deployment cycle.
I love that, a 3 to 5 year horizon. But before we sign off, I want to leave you, the listener, with one final, slightly provocative thought.
Oh boy, lay it on me.
Think about what Crown Castle just did. They amputated the messy fiber business. They paid off their toxic floating debt. They simplified their corporate structure to become the only pure-play macro tower operator in the U.S.
They scrubbed the balance sheet completely clean.
Right. So with the house scrubbed top to bottom, sitting on indispensable AI and 6G infrastructure, does this make Crown Castle the perfect, irresistible acquisition target for a massive private equity infrastructure fund?
Oh, wow. That is a compelling thesis.
Right.
Private equity loves pure play, monopolistic physical assets with contracted cash flows. And when a homeowner suddenly repaints the walls and fixes the roof,
It's usually because they're getting ready for an open house.
definitely something to keep an eye on over the next 24 months.
Absolutely. Well, thank you so much for joining us on this deep dive. We've translated the jargon, we've broken down the physics, and hopefully you are now the smartest person in the room regarding Crown Castle's latest quarter.
Keep asking the hard questions about where the cash is actually going.
We will catch you on the next one.